Hello, everyone, and welcome back to the G360 Wealth Podcast. Today, we have a very special guest in Mr. Joseph Wang from SyntheticFi.
Hello, sir. Nice to meet you, Rex. I'm a
It's great. It's great to have you. I'm excited for this conversation. Today, we're going to be talking all things box spreads, which is a very exciting new engineering method and lending method that I would say is hot off the press and there's getting a lot of attention so far. So, Joseph, I want to kick off the conversation simply by saying before we talk about who SyntheticFi is, what you guys do, and where you came from, at a very high level, for someone to understand what a box spread is, what the use case is, let's start there to kind of set the table so that everyone understands what these are, right? So tell me, what is a box spread and what's the use case?
Absolutely, Rex. And it's funny because I answered this question kind of all day Friday, and today is Friday. Um, but yeah, this is kind of like what we do at SyntheticFi is really trying to democratize this very obscure term box spreads from
Hmm.
traditionally a very ultra high net worth family office hedge fund level tool to a
Hmm.
much wider audience. What does it do in its essence? It's simply an instrument that you borrow money from the options market, exactly like a zero coupon bond. So let's say what we usually pretty much see is a Silicon Valley Apple engineer, right? He
Hmm.
has $2 million Apple stock and wants to buy $1 million house. Now he can just liquidate his Apple stock to buy the house, but he's going to pay a lot of capital gains. He's going to
Right.
miss out on the growth of the company and probably lose out on the path to retirement, kind of like set
Hmm.
back a little bit on his wealth plan, like his income plan in general. Instead, what he can do is to borrow against his Apple stock using box spread and get $1 million at around 4.5%,
Hmm.
and finance the house that way, right? So
Right.
box spread is a way, is a tool for people to borrow against their securities at ultra low rates with pretty flexible terms, additional tax benefits. We can get into that, but ultimately, it's a way to borrow against your securities.
Right. That's a great way to tee it up because, historically, this isn't a new thing, right? Especially executives you hear about all the time have been lending against their stock and their stock compensation for a very long period of time.
Mhm.
And it's, as you mentioned, something that was very prevalent in the ultra high net worth space and the millionaire and billionaire space. And oftentimes you see a lot of hit pieces and articles written on all the top best executives of why Elon Musk doesn't pay taxes and he didn't make any cash. And it's like, well, all these people are being very methodical about how they're generating liquidity, right? And
Mhm.
so, there's, I would say a lot of our clients are high net worth clients, and sometimes they have concentrated long term positions that could either be their executives or their business owners they have business interest in, or they have a portfolio of underlying positions that are either highly appreciated. So if they sell them to fund a need for liquidity, then they're going to pay taxes. And if they anticipate that the market does what it has done in history and it appreciates and goes up and compounds over time, then you're going to firstly pay the taxes. Secondly, you're going to miss out on that opportunity. We call that an opportunity cost of the upside capture, right? So there's a
Absolutely.
couple of things that we need to think about. Obviously, we're not in a black box, like we don't know exactly what's going to happen in the future. But for those clients that have either a large position in concentrated equity, they can't sell it for whatever reason if they're an executive, or they have blackout periods, or they simply just don't want to sell their stocks and give up that upside, but they still need that liquidity for home purchase, for a bridge loan, for whatever it may be. Box spreads and lending against your underlying positions have been awesome solutions to provide flexibility, right? So let's back up a little bit and talk about, traditionally you have securities backed line of credits, you have a traditional margin loan, and now we have box spreads, right? So
Mhm.
talk to me about why box spreads are the new, more engineered way that provide a little bit more flexibility. Why are they different fundamentally from what we've seen in the past from a traditional margin loan or a securities based line of credit?
Absolutely, Rex. I just want to chime in a little bit on the Elon Musk point. It's funny. This is actually we haven't talked about this publicly
Mm-hmm.
before, but just for friends of the pod, when we first launched this product, so we are a YC company, right?
Mm-hmm.
So YC as a is a early stage accelerator.
Yep.
They actually quote tweet a lot of times what the YC companies post. So in our
Mm-hmm.
first launch post, we tried to say at Elon Musk on Twitter, at Elon Musk, this is how people can borrow at this is how people can borrow like at Elon Musk, and we hope YC
Yep.
will quote tweet it. Elon Musk will respond to it, and YC basically sent us like a letter saying, "No, no, we don't do that."
That's great.
So yes, we tried to get Elon's attention but failed. But
Oh
that's a story
man.
for another time. But to your point, Rex, how is it different from, let's say, your traditional margin loan, right? Your traditional security-backed loan. Ultimately, we're cutting out the banking middleman here, right?
Mm-hmm.
For a S block or for a margin loan, you're borrowing from your custodian, you're borrowing from the bank, which you really don't have that many choices of, right? You have to just kind of agree with one or two interest rates they propose, and that's kind of it.
Mm-hmm.
Using box spread, we're going directly to the capital markets. We're going directly to the options capital markets, where hedge funds, family offices, and institutions has traditionally been the majority of the market. They give essentially, you can think about it as wholesale rates, right? What institutions are getting all the time. So
Mm-hmm.
we are bypassing the middleman to go to directly the source of capital and get the rates directly to your clients. So that's
Right.
really the core difference here is that Boxbar as an instrument allows us to do this bypass posture.
Mm-hmm. Absolutely. That's a great point. And I think, you mentioned the interest rate, right? When our
Mm-hmm.
clients and our prospects hear that they might be able to borrow at interest rates that are very close to the treasury bill rates, so right now in the 4 to 5% range, it's really attractive, right? Because when you
Absolutely.
compare that to the other options that they have, it's significantly undercutting the amount of interest that they're going to pay, right?
Mm-hmm.
So when we think about that, you said you go out to the options market, right? So, what's
Yes.
important for people to understand when you do that is you want to have something that has lots of liquidity, right? So for you guys, correct me if I'm wrong, but you're trading on SPX contracts, right? So that's
Mm-hmm.
S&P 500 contracts, which is one of the most volume in all of the options, right?
Four
So
trillion, $4 trillion a day, Rex. If we are really
very
reaching
very
that depth,
important.
I'll be I'll be a happy man.
So, Joseph, we've set the table now in terms of our clients now know that they can lend against their portfolio or collateralize their portfolio and get access to liquidity or cash at super attractive interest rates. Okay. So, when we think about this in practicality, how does that work, right? How does
Mm-hmm.
it work through the custodian? We tend to custody and clear through Fidelity and Schwab. I know you guys offer a few different platforms, and that might change in the future. But structurally, I want to give our listeners an understanding of the fact that they will actually open up an account with an advisor like us and their respective custodian, and they'll have a separate account manager, what we call a SAM account, right?
Mm-hmm.
And that is where we take our client's information, we open up the account, and then we assign a separate account manager in SyntheticFi to be able to trade and look through and report on that underlying account, right? So we're essentially giving you the hands-on experience and ability to make trades at your level with all of your knowledge within our client's account. So it's not like, you're wiring money or you're taking money out of your account, right? So why don't you set the table and walk our clients through and our prospects through, from start to finish. If we have
Mm-hmm.
a client that's interested in doing this, they already have a portfolio with Generation Capital Advisors. How does it work? How do we hire SyntheticFi to help give us liquidity?
Absolutely. And Rex, you're absolutely correct. We essentially act as a separate account manager to separate us from the main account so your
Hmm.
clients don't have to move anything while we are able to cross collateralize and use it
Hmm.
as collateral for the loan purposes. Right? From start to finish, if Rex, let's say, hey, I come to you today, say, Rex, I want $1 million against my $2 million portfolio.
Mm-hmm.
Rex is going to talk with us to say, hey, let's take a look at this client's portfolio, if it's suitable, and what are the
Mm-hmm.
risks, right? We're very particular about the risks to make sure
Mm-hmm.
that there's nothing left over to the portfolio. So once we determine, hey, yes, I think this $1 million is a good idea, we will work with Rex to assemble the correct materials that client needs to sign, right? So really on the client side, what they will come through is, hey, they will talk to Rex, they will talk to you, they will see one DocuSign with basically all the materials that they need to sign, with all the
Mm-hmm.
disclosures, all the need to knows. And once that document is signed, it will come back to SyntheticFi, come back to us. We will set up everything with Rex, and that's pretty much it,
That's
right?
it. It's super simple, right?
It is. It really is. That's actually one of it. Another tidbit here is some RIAs actually try to buy the technology specifically for this part, that we are
Mm-hmm.
able to connect to the custodians, assemble the materials, combine them, and give the end client a good, just like one signature experience.
It's a really seamless experience. And the thing to think about is that when our clients log into their Fidelity portal or their Schwab portal, right, they're going to see the underlying positions. So we'll go a little bit deeper and let you explain what you're doing with the actual options to create this Brock spread. But when they
Mhm.
log in, they're going to see those underlying positions. Now, with that being said, I think we should go a little bit deeper and tell us exactly what is going on in terms of what is being bought and what is being sold in order to create this box spread and ultimately to create a loan in the set term and the
Mhm.
amount that our clients are looking for.
Absolutely, Rex. And a box spread, as we go back to the basics a little bit, in its essence, is a zero coupon bond, right?
Mhm.
What is a zero coupon bond? It simply means you get cash up front. You're required to pay off a certain amount at a fixed future date.
Right. That's important. I'm going to jump in here. That's important because it is different from a traditional margin loan or mortgage based loan, right? Where you pay monthly interest payments and principal payments. With a box spread, it's all due at the finish, right? So at
Mhm.
maturity date, as they say, correct? So that's
Absolutely.
very important when you're modeling out your cash flow, whether you're, when you think about financial planning and tax planning, if you build this out, you're not going to have those monthly interest payments and coupon payments due, right? So this is a different structure. It's all due at that maturity date. Okay.
Absolutely, Rex. And for what it's worth, we are also able, this is actually what we do really well, is to tailor to your specific client needs.
Hmm.
So if your client, let's say, hey, really want a mortgage like amortization experience, right? Like they want to pay, let's say, 5% of
Hmm.
the principal plus interest every year, we can do that as well,
Hmm.
right? We basically orchestrate everything on our back end to make sure that your client can have a line of credit or a mortgage experience. That is all to say, all of those experiences are constructed by using a simple, humble box spread that is a zero coupon bond,
Hmm.
right?
Great. So why don't you walk us through what are you purchasing and what are you selling to create that box spread?
Absolutely. So this might be helpful if everyone here can check out our website,
Hmm.
synthecfi.com, under how it works. It shows you exactly what puts and calls we'll be buying. So just to visualize here a little bit, we are buying and selling both puts and calls on two different strike prices,
Hmm.
right? Let's do it for example. We can short a 5,000 call along a 5,000 put. Now, what does that create? That creates a synthetic short, meaning that it replicates the payout structure of selling something or tier SPX at 5,000 exactly.
Hmm.
Now, again, we short a 6,000 put and long a 6,000 call. For our listeners who know options, this sounds exactly like the reverse of what we did on 5,000, and that's exactly right.
Hmm.
We are basically constructing a synthetic long which replicates buying SPX at 6,000. So altogether, what do we have? We have a synthetic short, basically selling SPX at 5,000. We buy SPX at 6,000. So we're buying and selling the same thing at the same time. So the underlying structure really just cancels out. What really matters is the selling and buying price, the different two strike prices.
Right. So it doesn't matter the underlying price movement. So if SPX or the SP 500 goes down or up or flat, right?
Mhm.
Doesn't matter because they are
It does
canceling
not.
themselves out, right?
Exactly. You're buying and selling the same thing at the exact same time. No matter how they move, they will cancel each other out. And that's really important to know about box spread is because the box spread itself will not interact with the portfolio. It is self-hedged
Mhm.
as a bundle and self-contained as a loan.
Right. So you're essentially manufacturing or engineering an outcome, and it's very easy for us to understand what is going to be due at maturity based on the fact that options are priced perfectly, right? Or as efficient as possible. Okay. And so I guess, that's the interesting thing is why you can use this as an advantage. It's a lot of just math at the end of the day, right?
Absolutely. The first paper about box spreads used for borrowing purposes come out in the 70s. And it calls out exactly like, hey, this is a way to replicate essentially treasuries
Mhm.
if you use it correctly. It has been very popular among institutions, especially after the GFC, because during the financial crisis, people found out, oh, stock market can just not trade, and the bond market can just be haywire. But
Mhm.
the options market kept clearing; it never closed. As a result, actually, some hedge funds use it as last resort financing during that time period. And that's actually how
Interesting.
box spread
Yeah.
got a little bit more steam after GFC and trickled down to a little bit more the family office space. And then now the technology allows us to provide it to even a larger audience.
Yeah. It's very interesting. Okay, so now our clients know and they're intrigued. Their eyebrows have been raised, right? You're saying that I can borrow against my portfolio, still accept that long-term appreciation of our underlying investments, presuming they're going up during that time frame. And I can do so at a much lower interest rate than going out and getting a mortgage or going out and getting a margin loan or going out and get a security-based line of credit. It's too good to be true, Joseph, right?
Right. Yeah.
So let's take a little bit of a risk off approach and let me ask the basic questions of what are the key risks of using this as opposed to some of our other tools for liquidity, right?
Absolutely. The number one risk that we actually work with Rex here, if you're interested, we will work with Rex here to
Hmm.
work out extensively, is the margin call risk.
Right.
So ultimately, a box spread loan or box spread financing is a security backed financing method. That means the portfolio itself needs to be large enough to support the loan, right?
Right.
If the security falls by too much, it will trigger a margin call, just like margin loan, just like S
Hmm.
block, just like your mortgage, right? If your house value falls by too much, your mortgage people will call you say, hey, you can't really have this mortgage anymore. Like it's going to be called by
Right.
the bank. Or all security backed loans have the same type of risk. That's why you really do need an advisor to
Hmm.
be here to help you guide both to calculate, hey, what is the volatility of the portfolio? What are the chances realistically for the portfolio to fall by like 30%, 50%?
Right. And to simplify that, right, there's a couple key metrics that we look at as professionals when we're deciding how much collateral release gets involved here, right? Because if you're collateralizing a single concentrated stock, you're not going to want to release as much capital as if you have a basic 60-20-20 where it's 60% equities, 20% cash, and 20% fixed income, right? Because those are going to move slightly differently and their risk is adjusted based on that. So for let's call the average portfolio, Joseph, of
Mm-hmm.
60% stocks, 40% fixed income, what should we expect the upper limit to be? Now, that's not what we're
Yeah.
recommending you withdraw from. I want to be clear about that. But how much release? There's kind of two stages to this, but on the basic level, how much release would a Fidelity or Schwab give you on a traditional $1 million
Mhm.
60/40 portfolio?
The release rate is normally around 50%. Now,
Okay.
I say around because you could be holding, let's say, hey, super illiquid stock, or you could be
Right.
holding something that's esoteric. So I can't say for exactly that's 50,
Mhm.
but it's a good enough rule of thumb to start with.
Right. And there's certain nuances, right? Like options may not add to release, alternatives certainly are something to think about. Um, but in general, let's say 50%. Now, there is a tool that's becoming increasingly more popular for our, I would say, our more sophisticated investors and much more risk taking investors of what's called portfolio margin.
Mhm.
Now, this is a way to, I would say, supersize the amount of collateral that you receive, correct?
Absolutely. So for portfolio margin, the difference is they stop looking at security by security to determine your release rate. They look at the entire portfolio together. As a result, if you have, let's say, option hedges already built into your portfolio, this is a much more preferred way of getting the release.
Right.
And
And so if you're working with, if you're an executive or a business owner and you have concentrated positions that are, you might, if you're allowed to, you might have put a hedged on. That way you can sort of manufacture or protect on the downside. That would be a way for you to generate liquidity on a single stock. It's similar to how a prepaid forward for some of our folks in the broker dealer space that have gone through that in the past or are cognizant of. But it's a way for you to hedge the downside and get some release for that while still protecting from single stock exposure. So again,
absolutely,
that portfolio margin level is for our very sophisticated investors, our clients that are very comfortable with risk. But I want to come back down to the everyday John and Jane Smith that either might be looking to purchase a home or do a home renovation, or they just need liquidity, right? As long as you're under that, I'd say the 10% range is pretty safe. The 20% range is slightly more aggressive. Once you get closer to 50%, we need to really be cognizant of what's happening and monitoring the portfolio from if the account value drops, we need to have a plan in place because you will have something called a margin call, which basically means that you need to put up new capital to make sure that we are not having to force sell assets. As long as you work with us and we have a plan in place, we'll never get you in a position where we're going to, not have a game plan, right? We always want to be
absolutely,
conservative in these things and collateralizing a safe and conservative amount to fund your liquidity needs without putting you at potential for a margin call, right? So
absolutely.
we understand now that that is the biggest risk for investors. Now, what are the other risks in terms of, these contracts have maturity dates. And
It
so
does.
you have flexibility to either pay principal off or to hold it to the end. So what happens when, let's say we have a 3-year box spread. It was a renovation loan. I did the renovation, but
Mhm.
I'm really liking the way that this is working. My portfolio actually appreciated over the last 3 years, and I didn't have to pay anything because it was all due at the finish. So we're approaching the end or maturity date. What happens, Joseph? What is another risk that comes into play here? And what should I do if I want to roll it?
Absolutely, Rex. Like rolling is actually one of the things we regularly do here at SyntheticFi. That
Hmm.
is also pretty scary if you think about as an individual investor, right? Like you have to essentially settle the previous set of options and take out new options to cover what has been left over. That is what rolling is. It's as simple as basically taking out a new loan to cover what's been left over from the previous loan. And for us, we have the automated system to continue to do that basically programmatically. So we will know exactly how much to trade or how large the loan needs to be able to cover. And even a month before that, I'll reach out to you, Rex, to say, hey, this client is closing in on the rolling date, right? Does he want to pay off a little bit of the loan? Does he
Hmm.
just want to keep the loan rolling? Does he really just like his mission accomplished, wants to pay off
Right.
everything, right? It's all available on the table, and we're able to construct the rolling schedule accordingly.
Right. That's the beautiful thing is the flexibility that you're providing to your investors and clients, right? So, okay, John and Jane Smith are clients of ours. They did their renovation loan or they purchased their home. They've either paid off and they're now ready to close it out.
Mhm.
What we haven't talked about, besides all the pros and cons, is the tax angle here, right? It's very compelling for our clients. And can you walk us through what happens on the tax side of things? Specifically, what the deductions look like, and or if they have embedded gains in their
Mhm.
portfolio, why this is, again, another tertiary benefit is the way that tax treats these box spreads. So talk to me about the tax angle.
Absolutely. So box spreads in its essence are option trades. They are securities, right? So if you think about it, we talk about interest day in and day out, but for IRS purposes, they're carrying costs, right? You get $1 million today, you are due 1,000,005 in a year, right? That basically for IRS, what that means is you carry the security for a year and you lost like five, right? So that five or that 5% of the million is able to be deducted as a capital loss against all the capital gains and can be carried forward for other tax planning or just estate planning purposes,
Right.
right?
And that's huge because if you're holding on to positions over time and the market continues to do what it has done in the past, which is appreciate, you're in a position now where you have a capital gain. And so lots of our clients either have, equity compensation and or have highly appreciated positions, and then you have flexibility now that you have your liquidity, you can use it how you want to, but now you have some capital losses that are being generated, and then we can match those up one for one. If there's legacy positions that they don't want to own anymore and they want to rotate out of, if they want to rebalance their portfolio back to weightings because maybe equities have run a little bit more than you'd like and now you have a little bit too much equity exposure, we can utilize those capital losses in a very efficient way to not only fund, obviously you're getting all your liquidity, but at the same time you're getting the ability to rebalance, restructure, and de-risk if you so choose, right? So very
Mm-hmm.
useful case here. Okay, so a couple things that I want to think about. I want to run through a couple scenarios here in terms of we talked
Throw it
about
at me, Rex.
we
Yeah.
talked about liquidity, right? Everyone needs liquidity at some point or another. Um, I am Rex. I'm interested in purchasing a home. Okay. Let's say I have $1 million underlying position in my taxable account at Fidelity. I want to purchase a home and I need to put up $100,000 of cash, right?
Mm-hmm.
But I'm an investment guy, right? I love investments. I eat, sleep, and breathe investments. And I believe that the stock market is going to do well over the long term. And I don't want to sell my stocks and index ETFs to fund this cash. Talk me through. How do I use box spreads to solve this problem and give me the liquidity I need for that down payment on that home?
You call Rex and it's pretty much done. Like what
That's
else?
it.
What other answer do you want? Really, what we do here is basically we will set up a separate account to act as a loan account and
Mhm.
use the $1 million as collateral and use box spreads here to take out the $100,000 that
Mhm.
you would need for that particular purpose, right?
Great. And I'm only at 10%, right? That's not crazy. We
Exactly.
don't, as long as I'm in a moderately conservative portfolio, I'm not going to have too much risk of margin. We're going to be monitoring that at all times, obviously. But I'm only at the 10% collateralization rate. Okay. Let me throw another one at you. Let's say I own this home now
Mm-hmm.
and I have again another $1 million portfolio, but I want to make an extension to my house and build a back porch and patio and have a nice outside experience with a fire pit and a pool, and it's going to cost me $50,000 to do that renovation. What's difference? Same process, right?
Same process, yeah. And even if you, let's say you took out 100K before and now you
Hmm.
want to take another 50K, it's super easy. You just call Rex and cash is in your account almost next day. And you can wire it to your pool guy, you can wire it out to the renovations guy. And for those two 150 now combined, you can choose to pay it down or not pay it down or have a fixed rate, right? Like the flexibility here, Rex, as previously mentioned, is really one of the bigger selling points as well because
Right.
Rex, you probably remember like in 2022, 23, if your clients has a security back line at the time,
Hmm.
they see interest rate just go up quite a bit in a very short amount of time,
Right.
right? And that's because for almost all security backed products, interest is floating.
Yep.
So when the Fed raises rates, your interest payment goes up. But with us, you have the ability to say, hey, I think 4% is a pretty good rate. Let's just lock it in for
Hmm.
5 years, for 6 years, right? Then you will not pay like as long as you hold it to maturity, you
Right.
won't pay anything more than the you won't pay anything more than the 4% you locked it in, no matter how the rates environment has moved.
So there's an important thing you said there, as long as you hold it to maturity, right?
Yes,
In
sir.
some cases, when you're planning for this, and we build this into your financial plan and your cash flow plan over the next 2 years, we want to be cautious because if rates move against you, it might not be beneficial to pay that off early, right?
That's
You might have
correct.
a small debit in order to pay that off early because rates had moved against you. On the flip side, they could move with you, right? But
Hmm.
we always want to plan for the worst case. And so, in general, we should try and hold these to maturity. Is that a fair statement?
That's
It kind of
absolutely right.
depends, but in general,
That's absolutely right. Like we have the longer term products for the person who wants to more stability. If you're just
mhm,
like, hey, I'm really not sure how long I'm going to pay it off, then don't lock it, right? We have our line of credit like product that keeps rolling every 30 days
right,
so that it's just like a floating rate line of credit, right? So if you're
right,
not sure, opt for the ones that have more flexibility. If you're more sure about your long term financial plan and more sure about the use case of the loan, go for the longer fixed rate. It's really just
right.
like what the use case is at the end of the day.
Again, comes to flexibility. Okay, the one thing we haven't touched on, Joseph, is what's the minimum? What's the smallest amount that you can do this at, right? Is this just for the ultra high net worth? Are we only talking about, $1 million stock spreads, or how low can we go? Is it for the everyday person as well?
We can go as low as $10,000, Rex. Like, we really do believe that this is a tool that a lot more people should and
Mhm.
could have access to. So we really believe in our mission of democratization in this financial product. And we want you to say, hey, like, look at my new kitchen remodel. Like, this is financed by a box spread. We want you to see that, right? So, yeah, so our minimum is $10,000. Account size is slightly larger because you need to support that 10,000. But
Mhm.
really, we want to go as low as we can.
Right. Okay. So I think we're in a good position where we have a good understanding of what box spreads are, what the use cases are, what the risks are. And now, if there's listeners out there where they're like, wow, this is really interesting. I'm excited about the opportunity of this new financial engineering, right, which allows me to synthetically create liquidity. And they want to learn more. What's the best way to either learn and or to communicate with us, the advisor, about opening one of these?
Yeah, I think you can just go to your advisor and ask about, hey, do you guys do box spreads? Or have you
Mhm.
guys heard about SyntheticFi? Or, like I know one advisor who does it. So Rex, I mean,
We're open for business.
yeah.
So if you're out there, give us a ring, give us a call. We're happy to schedule a consultation. Again, we take a risk-based approach here, so we want to make sure that your portfolio is set up properly. We would never want to put you in a situation where you get margin called. This is an exceptional way for you to gain liquidity at super aggressive interest rates and super compelling interest rates. And ultimately, we have the flexibility by working with SyntheticFi to create a solution for you. No matter if you have $100,000 or $100 million, we can support you and meet you where you're at, and ultimately put a solution in front of you that's going to help you get the liquidity you need while without giving up the opportunity cost of selling your assets or generating that tax bill, right? So, lots of things to think about. Joseph, you did an exceptional job of taking a very complex product and
Thank you, sir.
simplifying it
Yeah.
for our audience. I really appreciate you coming on, and it's been a pleasure having you. Again, for our listeners out there that want to learn more about SyntheticFi, there's awesome stuff on their website. They also have done lots of other podcasts with some of the big names out there as well. If you want to learn more and listen to someone else besides myself. And more importantly, if you're interested in learning more about what a box spread and SyntheticFi could do to help you and your family, feel free to reach out to us. We'll coordinate some time to meet with the SyntheticFi team and bring a good solution to you. Okay?
Amazing. Thanks a lot for having me, Rex.
It's been a pleasure. All right, everyone. I hope you have a great rest of your day, and we'll see you on the next episode of the G360 Wealth Podcast. Take care.
Thanks for listening to the G360 Wealth Podcast. If today's episode gave you something to think about or act on, share it with someone who might need it. Don't forget to hit subscribe so you're always in the loop. If you want to learn more about how we help families like yours simplify and grow their wealth, visit us at generationcapitaladvisors.com. Until next time, take care and keep building. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Generation Capital Advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Integrated Partners, doing business as Generation Capital Advisors, a registered investment advisor. The information in this material is for general information only and is not intended to provide specific advice or recommendation for any individual. Integrated Partners does not provide legal, tax, or mortgage advice or services. Please consult your legal or tax advisor regarding your specific situation. All investing involves risk, including loss of principal. No strategy assures success or protects against loss.